By the end of this video, you will understand investments by the point of view of Warren Buffett. Let's roll with it. When Warren Buffett was 11 years old, he got the wrong idea of what investments were about. He charted the price fluctuations and read all technical analysis books he could get his hands on, and spent 8 years of his life thinking the important thing was to predict what a stock would do and somehow predict the stock market. He went like that until he read the Benjamin Graham book at an age of 19 to 20 years old, just to realize he was doing it the wrong way. From that day on, he forgotten buying stocks and started to buy businesses, and turned his point of view from a stock trader into an owner of businesses. He didn't care if a stock were going up or down the next week, the next month, or the next year. He stopped caring about what the market would do and started focusing on what businesses do. He was kind of obsessed on what he was doing, so he surrounded himself with people who brought out the best on him, and he dedicated his whole life to understand businesses. The thing about investments is that you don't have to be genius to be good at it. You just have to have what he calls the right orientation. As you can see, more than 90% of people that buy stocks don't manage it the right way. When people buy stocks, they expect it to go up by the next week. If the stock goes lower than the price they bought it, they start to feel bad. But by the point of view of Warren Buffett, if a stock he likes goes down, it is an opportunity to buy even more of that company. Since 1942, Warren Buffett never had less than 80% of his money invested on American businesses, and he didn't desire anything else. Warren Buffett was happy by having more than 80% of his money invested on businesses, and was also happy by being trusted by people. He liked working with his partners instead of doing it alone. You may also keep in mind that in today's world, contrary to what most people believe, people on average are more wealthy than ever before. For example, people now have mortgages at lower rates than ever before. And statistically, people nowadays can live better than John Rockefeller did 100 years ago. John Rockefeller was the richest man of the world, but today you can get better medicine, better education, better entertainment, better transportation, and you can do anything today better than Rockefeller could ever imagine. That means that 1 hour of work on today's world can get you more value than an hour of work 100 years ago. With a short amount of money, you can fly to another country, watch sports from a TV, and the electricity that Tesla and Edison made. Now it's yours to enjoy day after day. Warren Buffett bought his first stock when he was 11 years old, and he regrets not doing it even before. He entertained himself doing timing, charting, and reading books, but he didn't take profit out of it because he was working without a framework. He was seeking on his charting some type of trick that would help him make profits, but it still didn't. There are some things Warren learned from The Intelligent Investor from Benjamin Graham. One was that investors must have a specific attitude to react to market fluctuations. Mr. Market works as a partner on your business that tells you every day the price of your half part on the business, and you can either buy his half of the business or sell your half. Mr. Market behaves as a manic depressive, and you don't have to mind what he does unless it is to your advantage. You may wait until Mr. Market drops you a price from a particularly depressed day and buy his half part of the business and then sell it when Mr. Market gets euphoric and stuff. The thing is that you don't have to play with Mr. Market except when it is convenient to you. That's the point Benjamin Graham makes clear on his book. The market isn't there to instruct you or to tell you anything, but to serve you when you want it. You may have feelings about the stock you bought, but the stock doesn't know you have it. People just trade with it, so it has no feelings towards you. Other thing Graham tells is that you may value a business without knowing its price. If you see the price, it automatically has some influence in you. So you may value if the business has potential and results on the long term, and make sure it has a margin of safety. That means if you have a stock and you expect it to be worth $10 per share, you may buy it at $7 or less, so you have a safety margin of $3, and then try to buy as far the objective value as possible. Now, just by knowing that you may see stocks as a business, value its potential, and having a margin of safety. You may have a consistent investing philosophy that may help you on the long run. If we suppose you have to invest on a company in a week, or else give the money back, what do you think you should do on that week? Some companies may be familiar to you, others don't. Maybe you know them for their reputation, in others you know the management, in others don't. Perhaps you know the competitive situation. So how you will actually be screening these companies out. Take in mind that in this example, you have to choose one company that you won't be able to trade with that, so you're going to own it forever. In that case, you might look for businesses with enduring competitive advantage. It isn't necessarily the company that is earning the most money on the present, so you must look for the enduring competitive advantage. Take, for example, Coca-Cola, one of the biggest possessions Warren Buffett has. You see Coca-Cola, and 6 billion people on the world has an idea of what Coca-Cola is. Mostly favorable opinions, but if you watch for Big Cola or other generic cola, you may realize that even if that generic cola company spend $1 billion on advertising, people probably won't notice it. So, Coca-Cola is present on theaters, on Disney World, on football, and on any site that is related with happy experiences. And if others try to replicate it, they won't success on doing that. This is what is called an enduring competitive advantage. You also want your business to be run by honest and able people. But the best businesses are the ones that can be run by a silly guy. Because, as Peter Lynch said, buy a business that's so good that an idiot can run it, because sooner or later one will. Other fact with investment is that human mind, with billions and billions of possibilities, can choose the 4 choices that makes more sense. While machines has to evaluate all possibilities and make 1 million calculations per second to figure out the answer. The same thing applies to investing. You can cast out the 4 possibilities or investments that make sense and play around those choices, while trading bots and machines on the stock market fail again and again. Make sure that you don't make business mistakes that can take you out of the game. You should never have a night where you're worried about your investment, and also to get the money necessary to invest. You have to spend less than you earn. Is that simple? With that in mind, let's some additional tips on your investment journey. First, don't follow the herd. People always repeat the same mistakes of the past, such as excessive fear of the market or excessive euphoria. You must have to be clever to not follow the trend on investing matter. Second, attach to your purchase price. If we suppose 3 different persons bought a company at different prices and one lost 50% while other gained 5% and the last one gained 60%, they are all at the same page and should evaluate the future of the investment equally without caring about how they bought the stock right now. Third, debt management. Always remember that investment is not made for the impatient, and nothing screams to be desperate than a portfolio composed completely of borrowed money. When you take a loan, you can be right about your prediction, but you can also be wrong at it, so keep that in mind. And fourth, take care of aggressive growth projections. Stocks like Tesla and most companies that has a lot of market value try to defend their market value by reporting massive price per earnings and so on. And statistically, only 10% of the companies on the Standard and Poor's 500 can have earnings higher than 15%. I hope this video helped you to understand investment on a deeper perspective and remove all market noise that you got around. I'll see you on the next one.